Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoen here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're diving into the housing supply issues in Northeastern Ontario cities. Despite an uptick in housing starts, these cities are still struggling to keep up with the high demand. It's an interesting scenario because while more homes are being built, the available stock just isn't enough to meet the needs of buyers.
That's right, Sandy. In Sudbury, for instance, the housing inventory was at its lowest point ever earlier this year. We're talking about less than 2 months' worth of inventory. The Canada Mortgage and Housing Corporation reported a significant increase in housing starts, 164 from January to July 2025, which is a 113% increase from the previous year. But even with this growth, they're falling short of demand.
And Luke Bach, chair of the Sudbury Real Estate Board, pointed out that the biggest issue is the shortage of skilled trades workers. Without enough workers to build these homes, it's tough to keep up with the demand, even if the intention is there to build more.
Exactly, Sandy. We're seeing similar trends in North Bay and Sault Ste. Marie. In North Bay, home prices have jumped 10.3% compared to last year, with an average price of $522,856. Anita Kapitanchuk from the North Bay and Area Realtors Association mentioned that the recent cut in the Bank of Canada's key interest rate might spur even more demand from buyers. It seems like everyone was waiting to see if there'd be a rate change, and now that there has been, demand could increase further.
It's a double-edged sword, Steve. While lower interest rates can increase affordability for some, it could also drive demand further, exacerbating the supply issue. In Sault Ste. Marie, they used to have over 500 single-family homes available at any given time before the pandemic. Now, there are only 240 listings. Even though they surpassed their housing targets last year, it still isn't enough.
And that's the crux of it, Sandy. The housing market in these cities is very much in the seller's favor right now. With inventory levels so low, it's challenging for buyers to find homes, and it's pushing prices up. It's important for potential buyers to be aware of these trends and plan accordingly. We'll need to keep a close eye on how these dynamics play out in the coming months.
Steve, let's shift our focus to a significant call to action from the Appraisal Institute of Canada. They're urging the federal government to act decisively to strengthen and protect the housing market, especially as mortgage costs rise and economic uncertainty looms.
That's right, Sandy. The Appraisal Institute of Canada, or AIC, has delivered a set of recommendations in its 2025 pre-budget submission. They're emphasizing the importance of strengthening the federal banking framework by consulting with industry experts to identify regulatory vulnerabilities and enhance transparency.
Donna Dewar, the chief executive officer of the AIC, stressed that the federal government needs to prioritize clarity and stability in the housing system. She highlighted the importance of ongoing consultation with professional appraisers and industry leaders to achieve this.
The AIC is proposing the establishment of a permanent and multi-sector Stakeholder Advisory Committee within the Office of the Superintendent of Financial Institutions. This could be achieved through policy guidance and legislative changes, or by working directly with the superintendent.
They're also suggesting targeted amendments to the Bank Act to bolster financial stability, consumer protection, and lending integrity. The AIC's data shows that professional appraisers conducted nearly 1 million appraisals in 2024, valued at over $1.5 trillion. That's a substantial impact on the economy.
Absolutely, Sandy. What's interesting is that recent research by the AIC found that 9 in 10 Canadians trust appraisers over automated valuation models for accurate property values. Only 14% of respondents trusted AVMs more than professional appraisers, which speaks volumes about the need for human expertise in this sector.
The survey also revealed that 74% of Canadians believe regulators should oversee AVMs, and 4 out of 5 support the creation of a federal advisory committee to help guide Canada's mortgage system. It seems like there's a strong desire for more oversight and guidance.
And with the housing market being such a significant economic driver for Canada, Donna Dewar emphasized the need for prudent policy and strong leadership based on transparency, integrity, and consumer support. Without these, both Canadians and the financial system could face serious challenges.
Market risk and consumer protection are indeed crucial, Steve. As policymakers and industry leaders grapple with rising mortgage costs and affordability concerns, the AIC's call for action seems timely. The recent Bank of Canada rate cut might encourage more buyers, but it also adds complexity to real estate transactions.
Terry Dowell, the president of the AIC, mentioned the importance of brokers and borrowers connecting with appraisers early in the mortgage process. This helps spot potential issues before a deal falls through, ensuring that borrowers understand how their property is being valued.
Let's talk about the recent decision by the Bank of Canada to lower interest rates. This is the first time they've done so since March, and it's going to have a direct impact on variable mortgage rates. Steve, what are your thoughts on how this might shift the equation between fixed and variable rates?
Well, Sandy, Penelope Graham, a mortgage expert at ratehub.ca, mentioned that if lenders pass on the full 0.25 percentage point cut, we're looking at the lowest variable rates dropping from 3.95% to 3.70% for a 5-year term. That's a spread of 24 basis points compared to the lowest fixed rate, which is 3.94%. It's not a massive difference, but it's enough to catch the attention of those considering a variable rate.
Absolutely, Steve. And RateHub estimates that homeowners with variable mortgages could see some savings pretty quickly. For example, on an average priced home with a $624,277 mortgage, the savings could be about $84 per month if the rate drops from 3.95% to 3.70%. But it's important for homeowners to consider their risk tolerance when deciding between fixed and variable rates.
That's a key point, Sandy. We've seen how variable rates can rise just as quickly as they fall, sometimes even faster. Penelope Graham reminds us of the headwinds that could reignite inflation, which is something to keep in mind. But with the Royal Bank of Canada, TD Bank, CIBC, and BMO lowering their prime borrowing rates by a quarter point to 4.7%, there could be some short-term benefits for those with variable rates.
Indeed, Steve. And with the Bank of Canada lowering its policy rate to 2.5%, Governor Tiff Macklem pointed out that the risks have shifted since July, including a weaker labor market and a sharp drop in exports. This decision reflects the need to support a slowing economy with less upside risk to inflation.
It's interesting to note that bond yields, which influence fixed rates, are also under pressure due to the weaker outlook and the recent U.S. Federal Reserve's rate cut. The U.S. central bank has signaled that more cuts could be on the way, which might lead to further fixed rate reductions. It's a dynamic situation that borrowers need to watch closely.
And while Governor Macklem didn't provide specific guidance on future rate decisions, CIBC's senior economist Andrew Grantham expects another quarter-point cut in October. He believes the economy is losing resilience, and inflation will likely remain contained due to the high unemployment rate and the removal of retaliatory tariffs.
It's a complex landscape, Sandy. As potential buyers and current homeowners navigate these changes, it's crucial to stay informed and consider both immediate and long-term implications of mortgage rate decisions. Consulting with mortgage professionals and keeping an eye on economic indicators will be key in making well-informed decisions.
Now let's delve into a topic that's been on the minds of many. Will mortgage rates continue to drop following the recent rate cut by the United States Federal Reserve? It's an intriguing question, especially for those closely watching the market dynamics.
Indeed, Sandy. While the United States Federal Reserve's decision to cut rates by a quarter of a percentage point might suggest a potential drop in mortgage rates, it's not necessarily a given. According to Alex Vega, the relationship between the Fed's rate cuts and mortgage rates is not always direct or immediate.
That's a great point, Steve. Vega explains that mortgage rates are more closely tied to the yields on long-term bonds, particularly the 10-year Treasury note. These yields can be influenced by a variety of factors, including investor sentiment about the economy and inflation expectations.
Exactly, Sandy. The recent Fed rate cut is part of a broader strategy to support the slowing economy and manage inflation risks. However, the bond market might respond differently based on global economic conditions, geopolitical tensions, and other factors influencing investor behavior.
Vega also highlights that while the Fed's rate cut might lead to some downward pressure on mortgage rates, lenders might not immediately pass on these savings to consumers. The timing and degree to which mortgage rates might fall will depend on how lenders interpret the broader economic landscape.
And there's another angle to consider, Sandy. Some lenders might opt to maintain or even increase their rates to manage risks or improve their profit margins, particularly if they anticipate volatility in the market.
That's true, Steve. It's also worth noting that the Fed's actions can have indirect effects. For instance, if the Fed's rate cut boosts consumer confidence or spurs economic activity, it might eventually lead to changes in mortgage rates, but those changes could take time to materialize.
So, for now, potential homebuyers and those looking to refinance should stay informed and carefully monitor the market. Consulting with mortgage professionals can provide valuable guidance tailored to individual circumstances.
Absolutely, Steve. It's all about understanding the nuances of the market and making decisions that align with one's financial goals and risk tolerance. With that, let's wrap up today's episode.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.